Last time you were on the show was back in May. That's when Solidus Labs unveiled what the firm called the first insider trading detection tool specifically designed to monitor decentralized exchanges. And now we're seeing that tool in action through your new report, which found that insider trading in crypto is more prevalent than previously thought. Can you take us through data Solidus uncovered that speaks to this point? One point that stood out to me from the research: more than 50% of crypto token listings since 2021 show evidence of insider trading. What else did Solidus uncover?
Absolutely. Again, thank you for the opportunity to speak about this because we believe it's a massive issue of market integrity in these markets that needs to be addressed to fulfill crypto's potential. What we found looking at the listings of new tokens going back all the way to the beginning of 2021. So essentially, if we look at all the tokens listed across these exchanges, and I'm talking about centralized exchanges, just to be clear, across all of the tokens listed across of these exchanges since the beginning of 2021, 56% were accompanied by behavior that looks like insider trading. To be clear, what that means, someone essentially, most simply put, bought them right before they were listed or right before it was announced that it would be listed, and then sold them right afterwards. When we say someone, in this case, we're talking about cryptocurrency wallets. There's a lot of interesting stuff about how those wallets behave. We see, for example, oftentimes that those are wallets that weren't used or just created before those purchases. Again, indicating potentially that someone planned this and is trying to avoid evasion. We're also seeing a lot of instances where those actors are serial insider traders, meaning we see the same wallets or the same groups of wallets affiliated with this kind of behavior over and over. You pointed it out. This is a very high number. It's important to say it's an average. We only looked at this group of exchanges, but it's very, it's an issue across the industry as we're, looking at other places, at other exchanges as well. The bottom line is that at the moment, if you're buying, a newly listed token, there's a good chance that its price was affected by some of this behavior. And we believe it needs to be stopped because markets that aren't fair and transparent don't last. And crypto needs to decide: is it an industry of insiders, or is it a fair market that does everything it can to ensure this kind of stuff doesn't happen, to fulfill its potential to serve society better.
One interesting point that jumped out at me when I was reviewing this study: of the 234 token listings examined in the report since January 2021, I read that more than 130 have shown signs of insider activity, in some cases netting more than $200,000 in profits within minutes. Now, this study is the first part of your crypto market manipulation report series. As we discussed, this part, which was released last week, focuses on insider trading. It provides case studies, data, and explanations of the different methods used by crypto insiders. Can you take us through some of those methods?
The way to detect insider trading based on trading behavior is, essentially identifying, instances where people buy right before there's a big news event and sell right after that, that happened, meaning they knew that something was going to happen and use that information. And all of that, by the way, needs to be investigated and proven by law enforcement, to be indicted. In our case, the vast majority of the 411 instances that look like insider trading that we identified across these 131 tokens that you mentioned, most of those cases, the insider trading activity happened on DEXs, only on DEXs, meaning while the token was listed on a centralized exchange, the insider trader bought on a decentralized exchange and sold on a decentralized exchange, and then afterwards usually would transfer it in the direction of a few different wallets, to try and separate the funds and hedge the risk of being caught. There are cases, we've also seen some of them, where one of the instances, either the buy in the beginning or the sell, actually happens on a centralized exchange as well. And again, it emphasizes the fact that you have to look both on centralized crypto trading activity and decentralized crypto activity. You have to look at both off-chain activity and on-chain activity to really be able to see the full picture of potentially malicious and manipulative behavior. So in some cases, in quite a few of the cases, not the majority, but a few, you see that either the buyer or the seller is a centralized exchange and the other piece is on a decentralized exchange. There are also instances that we've identified where actually it happened only on centralized exchanges. That's a minority. That's obviously a small number of events. And again, just knowing a lot of the teams that work to prevent these things, there's really, really great work being done and very sophisticated crypto-specific policies that some of the most safety-forward and integrity-forward exchanges put in place to prevent this. But you still see that some of these instances happen on centralized exchanges. The main takeaway here is that the existence of assets on both centralized and decentralized exchanges is a game changer from an insider trading perspective. If you only know in traditional finance that an asset is traded in one place, right, and that place needs to have permission in order to have it traded, etc., then it's much easier to monitor and essentially, if you're a company that might have inside information, whether because you're the project itself that's listing a token, or you're an investor, there are multiple people stakeholders who might have insider information. In the traditional world, when assets are traded in defined places that are not decentralized only, you can more easily, ask your employees to report their wallets, etc., and then make sure that those wallets don't trade on that particular platform. But in the crypto world, where anyone can relatively easily open a new wallet, anyone can list a token on a decentralized exchange relatively easily. It just completely opens up opportunities to do insider trading in ways that are harder to catch. So again, there are different ways in which it's done, but the bottom line is that decentralized exchanges are a game changer in terms of enabling insider trading activity.
So is there any clear fix that stands out to you through the research, and does the nature of a blockchain play into that solution, given a blockchain is a public digital ledger used to record transactions?
100%. But one thing that people sometimes forget when they talk about assets like Bitcoin or Ethereum or just blockchain-based assets is that the assets are on the blockchain, but they can also be traded in a way that is not recorded on the blockchain. The majority of trading actually happened in centralized locations, centralized order books. That's not activity that necessarily is listed on the blockchain the same way, because it happens in a centralized way. And again, part of the challenge here is this cross on and off chain. And I'm sorry for the chain of hyphens in that sentence, but this cross on and off chain challenge of understanding trading when assets are being traded on both sides. But yes, the answer to your question is yes, there's a lot that can be done about it. And that's one of the most important things we tried to convey in this report. Not just that there's a problem, but also that there's a solution. Obviously, the solution to most problems start by identifying and defining the problem. That's part of what we're trying to do here. We define what insider trading looks like, and essentially we share this with the market. And you'll notice, it's not about any particular actor, because this is a problem across the entire industry. And we're looking at this as a phenomenon, that's broad, because we want the industry to do this, propose additional methodologies, and most importantly, use this tool in order to detect when it happens. The best way to detect scammers, manipulators, malicious actors from doing what they're doing is by deterring them. And there are already regulators and platforms that use our tool to do exactly that. Meaning, if you identify that something like that happened, there was insider trading around the listing, you immediately intervene. You follow the money to understand who it might have been, and you make it less profitable. And of course, at the same time, there's also a regulatory effort to look at these issues, provide clear regulation and requirements, and also, of course, chase, and ultimately catch, the people who actually have done illegal insider trading. So I want to emphasize here, while like almost anything else, like almost any other instance of illicit activity in crypto, it's obviously disheartening, because there's so many people who are working so hard to utilize this new technology to make finance work better for society. That's how I think about it. But like in any new industry, there's a lot of new challenges. A lot of the best things about crypto and DeFi and blockchain, the openness, the decentralization, the accessibility, create naturally some market integrity challenges, because when something is open, it's easier to do, for malicious actors to jump in and do something about it. But There's a huge opportunity here because essentially what our tool does is that it automatically detects, based on the blockchain's transparency, which you referenced, insider activity, which you would not have been able to do in traditional finance. It's very possible that much more, in traditional finance, you would usually detect a scam only if enough people were scammed to report it. And you usually detect insider trading in retrospect because, someone messed up. But here, because we actually can see all, in this particular case, all of these Ethereum transactions, you can create a reality where you can automatically detect this form of malicious behavior. All you have to do is to look at it efficiently enough. And that's something that regulators find very, very interesting. Again, seeing the challenges, but also the potential of creating a financial ecosystem where crime is harder to do as we utilize these sort of tools over time better and better.
Thank you for that comprehensive overview on your new report. But I have to ask you before you go, you were actually born and raised in Israel. So I'm curious to get your take on the country seizing $1.7 million in crypto it believes was used to finance Hezbollah and Iran's Revolutionary Guard. Chainalysis says its tools helped with the mission, and I actually spoke to the platform's VP of investigations about it this week. What is your reaction to that development from Israel?
Well, first of all, regardless of being Israeli, any time that's illicit funds are caught and recovered and prevented from going to where they were supposed to be going, which is to enable, in this particular case, terrorist activity, it's very, very good news. Obviously, great work done by some of our colleagues at Chainalysis, which are constantly showing, they're close partners of ours and are constantly showing the power of the blockchain, the fact that you can detect, this sort of behavior with more efficiency than you could in the traditional world. There's a coalition of really great organizations. I see Solidus as one of them, and we're very proud to be a part of this community that basically uses the blockchain in order to show that, in a blockchain-based financial ecosystem, it's actually harder, not easier, harder to enable illicit finance if you use the right tools. It's true for market manipulation and, like insider trading and market integrity, the things we're very focused on at Solidus, and it's true for financial terrorism, like in the instance that you're referring to. The cool thing is that over time, you can see how regulators and law enforcement agencies are realizing this. And if in the beginning there was a concern that, it's this blockchain is this new anonymous way that, a criminal's haven for transferring money, by now, through incidents like the one you just mentioned, Israel's seizing of financial terrorism money, or even if you look back at events like, the Bitfinex arrest at this point over a year ago, where you see a judge saying the only reason we were able to recover billions of dollars in Bitcoin, the biggest recovery of funds in the history of the Department of Justice of the United States, you can see a judge saying we were only able to recover these because they were on the blockchain. Again, there are a lot of people working really hard to make sure that we constantly have better tools in order to utilize blockchain's advantages, which is, the path to dealing with the challenges. So, as an Israeli and as a citizen of the world and as someone who really believes in the potential of blockchain, very exciting news. And again, it's some of these pick up, some of these get a lot of headlines, but this stuff happens all the time. There's a lot of work law enforcement is able to do very successfully to utilize blockchain in order to prevent crime and terrorism and other illicit activities.
Chen Arad with Solidus Labs, thank you very much for joining us once again. It's always a sincere pleasure.
Pleasure was mine. Thank you, Talia, for providing such important coverage for these issues as we are working to clean crypto and make it safe and regulated.